describes what will happen in the battle between buy-side and sell-side market forces and what it could mean for the financial future of the country. The event, hosted by Columbia University in New York City, is 50 minutes.
Someone asked me not too long ago why I wrote this book. It was very simple. I told them I can't play golf. Their reaction at the time was, wait a minute, as John said, you were an investment banker for 25 years. How could you be an investment banker and not play golf? I said I could tell good stories. And I had 25 years of interesting stories. In the first half of my career, I actually told stories about Wall Street's sellers. Wall Street sellers is really an army of commercial banks and investment banks. I would think of these sellers in a way as gatekeepers, okay? Folks in a way who controlled markets, created markets, controlled access to markets, and controlled information about those markets. While the Wall Street buyers, and I would think of them as the hedge funds, private equity firms, traditional money managers, for the most part of the 70s and 80s and 90s, had very limited power, had very limited influence. In many ways, they couldn't sit with the grown-ups. They couldn't sit with the sellers. But from the mid-90s on, in the last half of my career on Wall Street, I shifted my storytelling to the buyers. Things were changing. What we were seeing, in a way, was a sea of liquidity, an explosion, in a way, in financial technology, in financial information. And what was popping up, like mushrooms, okay, was buy-side advocates, who I will call the 3 E's: entrepreneurs, endowments, and electronic exchanges. So with liquidity, financial technology, access to information, as well as endowments like Columbia, the buy-side, the upstarts, in a way, these private equity firms, these hedge funds, in a way, seize the reins of power away from the traditional sell-side gatekeepers. They leveled the playing field. And for the first time, they could actually sit with the adults. They could enjoy the tasting menu. I had 25 years of those stories. But nothing like the stories we have seen in 2008. Nothing like the stories we're seeing every day in 2009. One of those stories, as we painfully know today, Wall Street was a house of cards. 2 noteworthy cards from that deck. 1, all the Wall Street firms underplayed the right hand, management. And 2, all the Wall Street firms overplayed the wrong hand, the balance sheet. What do I mean? When I think of management, when I think of these Wall Street titans, I'm reminded of the captain of the Titanic. Remember the movie, the book? What was the captain of the Titanic? Someone who thought he was invincible. Someone who ignored the warning signs. Someone who said, full steam ahead. Well, guess what? Our captains of Wall Street were doing fine. They were navigating through a sea of liquidity. Until when? They hit the credit-frozen iceberg. Or should I say, they smashed into the iceberg. As a result, they were guilty on 3 counts. Let's begin with guilt by omission. A number of these Wall Street CEOs, okay, buried their head in the sand. Instead of stepping forward and saying to us, hey, we have a problem. Let's try to fix it. I'll do whatever I can to fix it. They actually stepped backwards and hid behind others. Or better yet, were MIA, missing in action, at a time of alarming losses and write-offs. They couldn't be found. If some were guilty, okay, of omission, I would say others were guilty of commission. Some of these so-called Wall Street titans, okay, very early on in the credit crisis, late 2007, early 2008, came forward and told us, don't worry, the losses, the write-downs, behind us. is contained. Well, as we know today, our Wall Street friends faced even more alarming, faced even more drastic write-downs and losses. The problem wasn't contained in early 2008, as we all know today. Their expression, contained, was surely an understatement. But it's funny, when I think of their words, not to worry, the situation is contained, it actually brings back another memory. It brings back another interesting act, okay, of commission. 4 years or so before the financial bubble burst, May 2003, President Bush, you might recall, landed on the aircraft carrier. And do you remember the banner hanging over the ship? Not contained, mission accomplished. Talk about lack of trust. Over time, as a result, folks had a lack of trust. Well, as the credit crisis, okay, raged on, we had a lack of confidence. This lack of confidence took over. Fear overran Wall Street's favorite word, greed. Doesn't happen very often when fear replaces greed on Wall Street. But when it does, and it did in 2008, the financial system goes down quickly. What do? We shoot first and answer questions second. And it's not clear if there's a floor to the elevator. Let me put it in more practical terms. In times of greed, pre-credit crisis, okay, we price risk too low. The credit window is open all night. In times of fear, which is the credit crisis, we price risk too high. And as we know, the credit window is closed day and night. Let me give you an interesting example of that. Let me show you how the markets right now are pricing risk too high. The current equity values, right? The current equity markets are pricing risk or pricing the equity markets as if we're in a recession. That's fair. But the credit markets are pricing themselves today as if we are in a Great Depression. The markets are out of whack. Fear. Thinking about and going further back in time, in 2003, sorry, I like to play history, okay? Our Wall Street captains are guilty of a third count. They took a page from Russia's World War II playbook. What did Russia, or more interestingly, what did Stalin do when he entered World War II? He shot the generals. What did our Wall Street captains do? They shot the risk managers. They shot the senior executives. They shot the people who could have helped the CEOs navigate through the crisis. They could have helped the CEO say no. Okay? So while we were underplaying management, Wall Street couldn't help themselves, and they were overplaying the balance sheet. All the Wall Street firms, okay, were dancing to the same tune. And that tune had 4 words. Asset heavy, equity light. These Wall Street firms were stretching the balance sheet. Leverage, more leverage, supersized leverage, until that balance sheet broke. I'm okay with leverage up to a point. High leverage numbers, which these guys were playing in, 80% of the time is okay. Great profits. High leverage numbers, the other 20% of the time, it will catch up with you. And you are guaranteed to implode. Using this so-called supersized leverage with a very small movement in price, with a very small movement in the market, again, using that kind of leverage, you are guaranteed to be wiped out, which is what we've seen. Another way to put it, using supersized leverage, okay, as a basic business strategy is like riding a motorcycle without a helmet. Feels good until you fall off the motorcycle. You know, when I think of leverage, and I think of the credit crisis, and I'm sure you can think of this as well, there are other catalysts, other drivers that led us into the credit crisis. There's no question. We're living through a time of exotic, toxic asset classes. Credit default swaps. Okay, but that's old news. We've lived through that before. In the early 1980s, okay, we saw a thing called LDCs, loans to less developed countries. John, you remember those days? Those were the days we had defaults in Mexico, Brazil, and Argentina, and the ripple effect came right through the U.S. banks. We lived through it, we navigated through it, and we made it through it. But it wasn't just toxic assets we're living through today. We're also living through a time, as we know, of bad loan decisions. Loans to Joe the plumber. Loans to guys who didn't have a job, had very little income, and when the lender said, "Do you think you can pay us back?" the guy probably said, "I don't think so." But we still made the loan. But like LDCs, okay, that's old news. We've lived through that before. In the late 1980s, we lived through something called the savings and loan crisis and those wonderful, wonderful mortgages. My point here is if there is public enemy number one, if there's one thing I can point to as the leading catalyst behind our financial meltdown, leverage. Another way to say it is our Wall Street friends fell in love, femme fatale, with leverage. But leverage wasn't just a U.S. phenomenon, it was a global phenomenon. Thinking back to last semester, last fall, I see a few of my students here tonight. Thank you. You might recall, last September, we were sitting in a room, a little smaller than this, okay? And what happened? The financial freighters were going down. Lehman, AIG, to name two. My students said, "Hey, what's next? We've had a few guys at the checkout counter. Who's next on the hit list?" I said at the time, watch the European banks. It's not a U.S. phenomenon. Watch the European banks. I said, give it a couple of weeks. And guess what? I was wrong. It only took a week. Within 1 week, after we had the collapse of Lehman and Merrill and AIG, we saw the cascading effect in Europe. Am I that good? No. I only looked at one word, and I only applied very easy math. The one word was leverage. The easy math, simple. The U.S. investment banks were levered, assets divided by equity, of 30 to 1. Our friends in Europe were levered 40 to 1. One variable, one number. That's all it took to get a sense of the leverage. And guess what? Thanks to leverage, thanks to these captains of the Titanic, and I'll throw into the mix those toxic assets, what happened? Merrill Lynch watched its market value fall by $80 billion in 52 weeks. Lehman watched a blue chip stock become a penny stock. AIG watched its share price go, and fall from an equivalent of dinner for two, but a good bottle of wine here in the Upper West Side, to less than a New York City token ride, subway ride. That was the disasters of Wall Street. But let me turn our attention, this is Sipper, let me turn our attention from Wall Street to Capitol Hill. Let's talk about the regulators. That's always a good topic these days. Here's the question I pose. Where were the regulators when we fell off the financial cliff? Some will say they were driving in the dark. Others will say they missed the turn signals. As I wrote this book, I heard both sides of the argument. Some said, hey, wait a minute. We can't regulate innovation. Some said, wait a minute. You can't blame the regulators for the lenders. Remember Joe the plumber? Some said you can't blame the regulators because the problem is too diffused. What's the old saying? If you can't see it, you can't fix it. Okay. There were others who I spoke to when I did this book who said, wait a minute. The regulators do not deserve a get-out-of-jail-free card. They don't buy into, you can't see it, you can't fix it. They don't accept the excuses. It's the lenders, not the regulators. They're not going to accept the fact that the problem was diffused throughout the system. Why? Very simple. They look right back to the regulators. The regulators should have seen it. For that matter, we should have seen it. There was a flashing red light. There was a danger signal ahead of all of us. And it's been there for years. It was in the open. No one was trying to hide it. Ironically, when Lehman went down and Bear Stearns went down, it was on the balance sheet for us to see. And what's that word again? Leverage. It was there in the open. All of us could have seen it. And all we had to do is turn to the annual report, or 10Q, and we would have said 30 to 1, 40 to 1. Okay. That's only half of it. Okay? Because we live in a society that said unregulated capitalism. What does unregulated capitalism say? If you want to lever, you want to go 30 to 1, go ahead. What does unregulated capitalism say if it doesn't work? Thank you very much. It didn't work. We'll be smarter next time, right? Unregulated capitalism says we'll learn from it. We'll do a better job next time. Well, guess what? That song and dance doesn't work for me. Unregulated capitalism is a fairy tale calculus. Okay? In theory, unregulated capitalism says if you want to leverage up the wazoo, you want to take risk up the wazoo, go ahead. You may make it, you may not. But that's theory. In reality, what happens? Lives are destroyed. If you stumble with leverage, others will fall. And guess what? This is a society, in my opinion, that's not okay with that. This isn't a society of people living in the streets. We're not a society of people living in the sewers. We're not a society waiting for the next revolution to come. We're a society that picks up the pieces. We're a society that expects the regulators to pick up the pieces for us. There's a good bet they will. There's a good bet they will rework the financial model. Just a few weeks ago, President Obama came out and talked about financial transparency, financial reform. I smiled. As a student of history, okay, he actually pulled a page from the early 1900s. He actually pulled a page from Louis Brandeis. And that quote was, "Sunlight is the best disinfectant. We need more sunlight." That, you know something? I, for one, don't want to just rely on the regulators. I don't think you do either. I, for one, don't want to rely on the accountants either. I want to turn it around. Turn the spotlight around to the financial community. Allow me tonight to play pundit. Allow me to toss out a few suggestions here at SIPRA tonight. That's the first time I can do that, right, John? Where do I begin? Let's start with the rating agencies. They've gotten a fair amount of press. Who pays the rating agencies? Well, the rating agencies are paid by the sellers. Remember the sellers? The issuers. Remember the sellers? The gatekeepers. Remember the sellers? The banks. That's funny. Those are the same people the rating agency is supposed to police, and they're paying them. I don't know about you, but that's a little sticky for me. One fix, okay, would be, who else? Who do we call? The government. Let's have Uncle Sam pay for it. They seem to be paying for a lot these days. No. Yes, it would be an easy fix, but I think it would be a bad fix. My fix? Again, turn it around. This time, turn the spotlight to the buyers, not the sellers. Turn it back to the investors, not the issuers. Why? These are the guys that buy the securities. They have too much skin in the game. I would go to the buyers, Wall Street buyers, hedge funds, private equity, all the investors. And I say, guys, it's simple. You need better oversight. It's not working. Pay for it. Fund the rating agencies. Have the buy side step up and pay for it. A tiny amount, a small slice of your assets under management. We're not talking about a lot of money, but enough money to pay the rating agencies to keep them independent and standalone and away from the sell side. We need accountability. More importantly, we need, I think, better oversight. Someone has to pay them. I think you'll be better served. I think we will be better served in the long run if you guys step up and do it. In a sense, self-police yourself. You're buying these securities, put a little money in. That's the rating agencies. Let's talk about the financial community. Here's one for you. You ready? Pay to play. Every time I hear a commercial bank, an investment bank, a hedge fund, call it what you will, wants to trade in a risky asset class, derivatives, for example, guess what? Pay for it. Not a lot. Pay X dollars or Y% of the trade. Have these firms, every time they trade a risky asset, not all assets, a risky asset class, move money from their cash registers into a general protection fund. Now I can see going to Wall Street with that suggestion. And I'm guessing they'll probably come back at me and try to knock my door down. Or should I say, blow my door down. My response to Wall Street would be, or the financial community in general, hey guys, it's simple. I'm not recommending stopping overall risk taking. I'm not saying you shouldn't take risk. What I am recommending, okay, is you contain the risk. Certain aspects of risk. Risks that are dangerous to the rest of us. We've seen the effect of that. It doesn't work, that risk. Okay? Now, the Wall Street firms, again, what will they think about? Well, the good news is, if I go to them with pay to play, I know they'll think about the cost, right? But I want more than that. I want them to stop and think about the risk. Again, self-policing. Maybe if they stop and think about the risk, and there's a cost to it, they just might not dive into the pool and splash the rest of us. What I would say to the financial community, it's very simple. It's time to become dues-paying members. Pay to play. I would say to the Wall Street and financial community, guess what? When you go to the casino and you take risk, you pay for your chips. They're not free. And the other added benefit, okay, of having these Wall Street firms, the financial community, pay to play, they're paying, not the taxpayers. And we're hopefully building up this general protection fund for our next time. Let's take this pay-to-play concept. Let's take the spotlight on the financial community in a different direction. Let's try something called executive compensation. We've been reading a lot the last couple of weeks. Obama's plan, right? Capping CEO pay at each company if they take government assistance. That's not nearly enough. Let's step back. Let's just not talk about CEO pay. Let's talk about the top 5 folks' pay at a company, the top 10 folks' pay at a company. Let's talk about compensation across the board. We are paying too much compensation, not just to the CEO, not just to those top 5 or top 10, but to hundreds and thousands of people. Explain to me how we pay huge amounts of compensation to companies that are either unsuccessful or, better yet, are insolvent. That's beyond insane to me to pay for someone that's insolvent. We need to change the arithmetic. And guess what? Again, it's very, very simple math. No profits, no bonuses. Now, I'm for bonuses with one caveat. Let's call it a clawback provision. Let's call it, in this example, in year 1, company has profits, pay the bonuses. But if there's no profits in year 2, and there's no profits, right, in year 3, I would like the company, the senior managers, to give back the bonuses from year 1, a clawback. In reality, they were paid for something, right, in year 1 that they shouldn't have been paid for. To me, it's very simple. You shouldn't be paid big bucks just because your job is spelled CEO or CFO or COO. Now, some people might say to me, wait a minute, you clamp down like that on executive compensation across the board, people will leave. My response, they're not going anywhere. There's nowhere to go. Sorry, guys. There's nowhere to go. Again, simple math, simple philosophy. If the company is unsuccessful, no bonuses, no free lunch. If the company is successful over a reasonable time frame, take the pot of goat home and lunch on me. One last thought. Now that I'm throwing ideas out, okay? Let's talk about financial transparency. I love that line, by the way. Sunlight's the best disinfectant. But I think we got to go a little further than one-liners. As we know, we have individual company reporting, annual reports. Companies tell us what they want to tell us in their annual reports. I want to go one step further. I want national reporting. I want a national exchange, a national tracking house that tracks every single risky trade, that tracks every derivative position, that tracks every counterparty position. I want to identify where there's high risk in the system. I want a clearinghouse or a tracking house that identifies the risk in every hand and every transaction. I want to know where the risk is. I want to see it. And I'll decide if I want to play. Because the annual report doesn't work for me. I want to know who's holding the cards. We have too much exposure to counterparty risk and derivatives around the world. This is a global issue. Let's know who's holding on to the risk. Telling me your annual report? Okay. But show me in some kind of national exchange that identifies this, tracks this. Sounds great. And I'm sure when I go to the financial community, the welcome wagon will be out of service that day. I'll call and they won't pick up the phone. Why? You know, it's funny. I don't think the financial community cares about the cost of my suggestion of a national tracking system. I really don't. I don't think it'll be a cost issue. I don't think they'll pick up the phone because it's a cost. because I think it's more important to them to keep their trades private. I think it's more important to them to keep their trades proprietary. That's why they won't call me back. That's why the welcome wagon will be out of service. Cost? No. Holding on to what they think is private and proprietary. Well, guess what? To those companies, okay, that absolutely resist this national reporting system, to those companies that actually resist pay-to-play, remember, for certain specific asset classes, risky asset classes, and to those companies that resist, right, aligning compensation to success across the board, to those companies that resist, I only have one sentence for them. Nice knowing you. Move to Madagascar. Move to your own island. The theoretical argument that we live in a completely free market society doesn't work for me. I don't think it works in general. Everything in the United States is regulated. Patents on pharmaceutical companies don't go on forever. They have a life, right? A shelf life of 18 years. Companies in the United States cannot fire people on a whim. Companies in the United States can't pollute wherever they want. We have rules and we have regulations. Very different than a runaway market. In closing, let me pull a page from the medical playbook. Penicillin. Remember penicillin? It was the all-encompassing cure. It worked great for a long, long time. Until what? We built up a resistance. Bacteria popped up all over the place. What did the medical companies do? They reworked the drugs. They made it a win-win for them and their patients. So I say here tonight to the Wall Street sellers, the Wall Street buyers, as well as the regulators, it's time to change the financial landscape. It's time to change and rework the financial model. We, you, we, and them, all of us, will be healthier in the long run if we make these changes today. Let me open it up to questions.
Thank you, Richard.
Thank you.
The floor is open to questions. Here. Wait for the microphone, please, and let us know who you are.
I'm Akbar Noman. I also teach here at SIPA. The question, you said the 30-to-1 ratio of equity to assets was clearly very highly leveraged. What was it historically? What is a sound banking practice? What is some sort of norm of this kind of ratio?
I'm not sure there's anything normal in the capital markets. But I would say I would be more comfortable on a more conservative number of, say, 10-to-1 or 8-to-1. I think the good news, the silver lining in this crisis, is that the leverage ratios of the past, 30-to-1, 40-to-1, is off the table. So I think the ratios that I'm more comfortable with, that you should be more comfortable with, single digits, less than 10-to-1, will probably be in vogue. Our friends on Wall Street won't be happy with that, but that's the new order of the day.
Question? Yes, over here.
Thank you very much. I'm Stephanie Griffith-Jones. I run financial programs at the Initiative for Policy Dialogue. I wanted to follow up on the previous question from my colleague. In fact, Basel required 8%, so the leverage actually should have been 12. Or 12.5. So what happened, I think that the Wall Street and city actors got round the rules, and this is a problem of regulatory arbitrage, I think. But more generally, I wanted to ask, do you think that the Wall Street actors would themselves do this? Would they, for example, create themselves this general protection fund, which is obviously an interesting idea, but would there be not a collective action problem about them wanting to do it? And doesn't the regulation have to come really from the governments or from the regulators on things like remuneration? Can we kind of trust the private sector after all that happened to do it on their own? And are they able to? Or would it be better, including for the financial sector itself, actually, for it to be done by regulators?
You know, that's a great question, thank you. But we have a precedent for that. I hate to bring up the name Elliot Spitzer, but there was a time when Elliot Spitzer was raiding Wall Street, not hotels in Washington. Okay? Back then, what did Spitzer come up with? A thing called the global settlement. Why was there a thing called the global settlement? A little history. We've had problems with Wall Street forever. Back in the 80s, in the 70s, John, you might recall this.
How much do you?
Too much too young. I was going to use that. There was a huge conflict of interest. Remember, between the research departments and the investment bankers? The research department would say, what? I'm going to put a sell order in. Remember? And they get a call from the investment bankers. And they say, what are you doing? You can't put a sell order in. That's our client on the investment banking side. There was inherent conflicts. Talk about Basel. There was inherent conflicts. We all know about WorldCom and Enron, right? The stock's coming down faster than a meteor, right? And what are the Wall Street firms doing? They're recommending us to buy it. Because what? Enron was putting a lot of money in whose hands? Wall Street's hands. We, the investor, was secondary. Spitzer and others came up with the global settlement. They separated research from investment banking, no more inherent conflict, and they made the Wall Street firms pay for a global fund for restitution and solve the issue. We have to step in and force these guys to pay to play. We did it before. They didn't like it, but they lived with it. And today, I can promise you, research sits over here and investment banking sits over here. It's not as lucrative as it used to be, but at least we put the Chinese wall in place. We have to protect ourselves. And I'm happy to talk about the bad bank, which is getting a lot of press as well today, because I think we're going nowhere with that, and I have an idea on that too. By the way, I'm happy to throw anything out. Please.
Question here.
Hi, my name is Julia Kotlar. I'm a student here at SEPA, and I took your class, Professor Goldberg,
And
last year.
you came back tonight?
Yes. I was wondering, given the ambiguity that's allowed within the International Financial Reporting Standards, how do you feel they will impact the financial services industry, given that we require sound accounting and auditing of financial systems or financial statements within the financial system?
I love the accounting profession. I think the accountants do a great job. But I think for us just to rely on accounting standards or Basel, just to rely on the regulators is a mistake. We have to put it back to the people, right, who are creative, who are intuitive, who can, right, who can fool us. These are clever folks. They're going to find ways to skirt the system. GAAP accounting is great, but it's a snapshot. As we know from mark-to-market accounting, right, it doesn't tell us everything we need to know. We need more, much more. And we need partnerships. Since I threw out the bad bank idea before, may I? There's a lot of press on whether we should have a bad bank or not. The politicians will tell us, right, it's a question of cost. We can't have a bad bank. It'll cost trillions of dollars. My response to the politicians is, if you ignore it, the problem doesn't go away. The cost is the cost. I have a very simple proverb. It's only too expensive if it overstates the actual and real costs. We need a bad bank. Why don't we have a bad bank? Other than the politicians might think it's too expensive. It's a question of price, right? We've heard this in all our newspapers. It's a question of valuation, right? If the government buys the assets from the bank too low, right, puts too low a value on buying those assets from the good bank to the bad bank, who gets hurt? The bank. It's all downside. If the government buys the assets too high, right, from the good bank to the bad bank, they price it higher, there's no upside for the investors, the taxpayers, right? Banks like it. Higher value. We don't like it because less of an upside for us. Guess what? It's simple. It's so simple. Make it a partnership. We need one big bad bank, a special purpose vehicle, put a fence around all the bad assets, and here's the twist. Make the banks stockholders in the bad bank. Make the banks price the assets, not the government. Take the pricing critical issue, too high, too low, to the banks. If the banks become stockholders, they'll probably price it right. And even if they price it too low, right, and take that hit, which we're all worried about, well, at least they get the upside. Let's not put it on the bank's shoulders. Let's not put it on the taxpayers' shoulders. Make the banks become shareholders in one big bank. Let them set the price. Therefore, the pricing won't be as critical. We've done it. We moved the assets away. We put a fence around it. I have a very easy general principle. We need to do more, and we need to do it quicker.
Isn't there a middle ground here between, on the one hand, regulating, imposing firewalls, controlling executive compensation, creating insurance funds so if things go bad, using the courts to discover fraud and abuse on the one hand, and catastrophe on the other? Wouldn't it make more sense just to nationalize them all, internalize all the costs of this insurance and regulation, set decision rules from the government, hire bureaucrats, and get on with it?
You know,
Isn't that what the Republicans are now proposing?
I never thought the day would come the Republicans would be asking for nationalization. That's a great, great question. And nationalization is going to be a word we're going to hear every day, right, for months. And I'm glad you brought it up, John, because I have a response to that too. And as you probably heard in the last 45 minutes or so, I have different responses. Effectively, to answer your question, John, the banks are nationalized. But this is what I find very ironic. In a strict capital society, okay, think of it this way. What does strict economics say? What does strict capitalists say, including the Republicans? If I put money into a troubled situation, I deserve equity. I deserve control. Any investor putting any amount of money into any distressed situation doesn't say, hey, take the money and take the equity and take the control. It doesn't work like that. My point, John, is right now the government, more importantly the taxpayer, is not getting the equity or the control for their investment. Your point, nationalize it. My point, split the baby. Sorry, I'm more moderate. What I would do, okay, again, a partnership. We need to work together. I want the government, I want the taxpayers to have equity in the banks. Why? The equity in the banks today, economically, is gone. It's been wiped out. Sorry, guys who have equity in banks. The only reason why the banks are still standing or have any semblance of equity is because the government is doing what? Supporting it with loans, with guarantees, with preferred stock. My point again is split the baby. I want the taxpayer, the government, to have more upside. Absolutely. I want the taxpayer to have a better return on their investment. Absolutely. I agree, John, we need more control of the banks. But where I split the baby and where I draw the line, I don't want the government running the banks. I want to leave the control of the banks to the banks. I think it's impractical for this government to be running banks. We need more control. We need better economics, but we don't need managerial control. Split the baby. And as I'm splitting that baby, I would ask for four things. One, again, equity, sorry, gone. Recap the banks. We have no choice. Two, the bad bank idea I put out before. We need to wipe it off the books. We need to rebuild confidence. We can't do it incrementally. Three, where it's practical, consolidate all the banks. You can, not all the banks, but consolidate the banks that need to be consolidated. And where it's practical, break up the banks that need to be broken up. But have the government do it in partnership with the private sector. So I guess what I'm saying is partial nationalization. Sorry.
We have time for one or two more questions. Over here.
Thank you. One observation and a question. The
That's
observation,
probably the government calling me now.
the observation is your model about sort of, paying the rating agencies, and splitting essentially the buyers from the sellers. Well, the investment bank model has basically led to effectively the sellers and buyers basically being one and the same thing. I mean, somebody who worked in the bank several years ago, I mean, these Chinese walls, they don't always sort of work as I sort of know. And recent events like, I mean, say Barclays effectively sort of buying out investment part of layman's is the case in point. You're just actually reinforcing essentially banks and investment. But the question, you may want to respond to that observation, but the question is, why do you think the Canadian banking system has done so much better than the American one?
Well, that's a good question. The question is, has it? How much of the Canadian banking system, all right, and this is simpler, a global question. The question has been put to me many times. Which countries will come out of this first? Which countries are more affected by this? And it's country by country. Canada is a commodity-driven society, right? It's a commodity-driven market. They've been sustainable because of commodities. They've been sustainable because what I'd like to have seen in the stimulus package was more direct spending on infrastructure, on commodities, on raw materials. Canada has that. That helped buffer the storm. Also, how many banks are there in Canada? Not that many.
There's about 4 now in the top 15, and we're at 4 of them.
Again, go back to the concept, I'm afraid to say, where it's practical, try to consolidate some of these American banks. Not all the banks. Remember, going back to the savings and loan crisis, okay? Late 1980s, early 1990s. We lost what, 2,000 banks? 2,000 thrifts? But if we do it in a practical way, where we can save jobs, hopefully, in consolidation, try to save as many as we can, and protect the deposit base, I'm all for it. I'm all for helping the investor.
The book is called The Battle for Wall Street, Behind the Lines in a Struggle That Pushed an Industry into Turmoil. You've heard from the author, Richard Goldberg, and now SEPA's typically lavish reception awaits you outside. Richard, thank you very much.
Thanks, created markets, controlled access to markets, and controlled information about those markets. While the Wall Street buyers, and I would think of them as the hedge funds, private equity firms, traditional money managers, for the most part of the 70s and 80s and 90s, had very limited power, had very limited influence. In many ways, they couldn't sit with the grown-ups. They couldn't sit with the sellers. But from the mid-90s on, in the last half of my career on Wall Street, I shifted my storytelling to the buyers. Things were changing. What we were seeing, in a way, was a sea of liquidity, an explosion, in a way, in financial technology, in financial information. And what was popping up, like mushrooms, okay, was buy-side advocates, who I will call the 3 E's: entrepreneurs, endowments, and electronic exchanges.
Describes what will happen in the battle between buy-side and sell-side market forces and what it could mean for the financial future of the country. The event, hosted by Columbia University in New York City, is 50 minutes.
Someone asked me not too long ago why I wrote this book. It was very simple. I told them I can't play golf. Their reaction at the time was, wait a minute, as John said, you were an investment banker for 25 years. How could you be an investment banker and not play golf? I said I could tell good stories. And I had 25 years of interesting stories. In the first half of my career, I actually told stories about Wall Street's sellers. Wall Street sellers is really an army of commercial banks and investment banks. I would think of these sellers in a way as gatekeepers, okay? Folks, in a way, who controlled markets, so with liquidity, financial technology, access to information, as well as endowments like Columbia, the buy side, the upstarts, in a way, these private equity firms, these hedge funds, in a way, seize the reins of power away from the traditional sell-side gatekeepers. They leveled the playing field. And for the first time, they could actually sit with the adults. They could enjoy the tasting menu. I had 25 years of those stories, but nothing nothing like the stories we have seen in 2008. Nothing like the stories we're seeing every day in 2009. One of those stories, as we painfully know today, Wall Street was a house of cards. Two noteworthy cards from that deck. One, all the Wall Street firms underplayed the right hand, management. And two, all the Wall Street firms overplayed the wrong hand, the balance sheet. What do I mean? When I think of management, when I think of these Wall Street titans, I'm reminded of the captain of the Titanic. Remember the movie, the book? What was the captain of the Titanic? Someone who thought he was invincible. Someone who ignored the warning signs. Someone who said, full steam ahead. Well, guess what? Our captains of Wall Street were doing fine. They were navigating through a sea of liquidity. Until when? They hit the credit-frozen iceberg. Or should I say, they smashed into the iceberg. As a result, they were guilty on 3 counts. Let's begin with guilt by omission. A number of these Wall Street CEOs, okay, buried their head in the sand. Instead of stepping forward and saying to us, hey, we have a problem. Let's try to fix it. I'll do whatever I can to fix it. They actually stepped backwards and hid behind others. Or better yet, were MIA, missing in action, at a time of alarming losses and write-offs. They couldn't be found. If some were guilty, okay, of omission, I would say others were guilty of commission. Some of these so-called Wall Street titans, okay, very early on in the credit crisis, late 2007, early 2008, came forward and told us, don't worry, the losses, the write-downs behind us is contained. Well, as we know today, our Wall Street friends faced even more alarming, faced even more drastic write-downs and losses. The problem